Hey, good morning, traders and investors, and welcome back to the Trading Analysis Wednesday live stream show. I'm your host, Bennett Tyndall. Hope you're doing well this morning. Thanks for taking time out of your busy Wednesday mornings. Happy August 24th to you all. I can't believe we are already approaching the end of August. Hey, we do apologize for not being with you last week. Hopefully you caught me at the LIQUIDITY Forecasting Hub webinar last Wednesday afternoon. But the previous week we had discussed overhead resistance in the indexes, looking for the start of a wave forward pullback, and it does look as if that is upon us. That would, of course, be in the bullish case. We'll get to the charts in just a few minutes. Before we get to the charts, we're going to bring in the trading analysis team. Good morning, gentlemen. How are you doing today?
Hey, guys. What's going on?
Morning, Bennett.
Welcome, welcome. Todd, Terry, Alex, how are you all today?
We're good. Good. Just happy to join you guys once again. Hope you're well. Hey, do you guys all see Top Gun? Do you guys all see Maverick?
Yeah.
I'm ashamed to say I haven't seen the new one.
Yeah, it was good. Very good. Well done.
It was like it was. My wife and I finally watched it. It's out. You can buy it now. But it was so built up, and like Bennett, I was waiting for we were waiting for the perfect night. Like it was so built up. I heard such good things. It was impressive. What'd you think, Terry? We won't ruin anything, but what'd you think?
Oh yeah, no, it was true to the original storyline and the character, and I think the neat thing about it was all the actors were actually flying in those planes. Now there was, of course,
I was wondering about that.
Flying the plane, but they were actually sitting in the cockpit with like six cameras all around the high resolution video cameras. And so they were pulling those. They had to learn how to pull those G's. They had to get into shape. That's for sure.
That was crazy. That was awesome. Yeah, I want to get off too much. We should talk about offline, but I thought it was.
I didn't know it was out already. I'm gonna have to watch that this weekend.
Last night, and it's funny. Like for the third time in 3 weeks, we lost power, and Trish and I were all ready to watch it. And we lost power, so I'm going to get on the bid for GNRC, Generac, which I'm actually watching a wave count. It doesn't look great on that wave count, but it's time to go. Anyway, sorry to interrupt. Good morning, guys. Miss you all.
For sure.
It's quiet on the wealth management side. It's quiet over here. Positions are good. So we have. I've been hanging with the TA guys, working that right now. But markets are quiet for the most part. But then it'll get you straight.
Yeah, absolutely. We'll take you through the indexes, take you through the MotiveWave platform. Terry's got his Generac going. I've got to get on the list. So, didn't you?
Do you have a Generac, Jersey?
Yeah,
I had one.
Got it installed in March. So, and I actually had the opportunity to use it. Had a power knocked out for about an hour or so a couple of weeks ago. So, it works. Comes on in less than a minute and.
Yeah,
just purrs.
Can't beat that.
Again, sorry, we'll get back on track. I'm trying to remember, we bought one in Jersey. Do they measure them by kilowatts? Is it like 15,000 kWs? Is that what it was? Or
I got a 24 kW. It's a full house.
Full house, okay.
Yeah, 24 kW will run your whole house. All your air conditioners, refrigerators, freezers, TVs, appliances, everything, even your ovens.
You're the Trading Analysis Recovery Center.
Sounds like a good business expense. All right, let's hit it. Hey, we're going to take you through the indexes. Gentlemen, I'll be back on the other side, and we will carry on from there. Catch you in just a couple minutes. All right, let's hit it. Hard right edge of the MotiveWave platform. First, taking a look at price action in the S&P 500. We'll go full screen on the charts. It's been, I tell you what, you miss a week on the live stream and the stream deck buttons just go haywire on you. So let's hit it here. We're taking a look first at the highest degree of trend, and I continue to remind you of the higher degree trend and the opportunity zone that we do see over the next 2 to 4 weeks, where markets can either confirm upside continuation from the June 17th lows and secure that as the end of the 22 correction, or alternatively, we are still tracking a wave count that in the event we see downside acceleration through support, would suggest that a move under 39.45 would immediately open the door back to the 36.36 area low. So we continue to remain optimistic, and although we are tracking this in the background, our preferred view continues to be the bullish interpretation, which is supported if you take a look at the positive developments that we've seen across many growth sectors, many growth industry groups. Specifically, the semiconductor industry group has a beautiful 5-wave rally. We talked about that last month, put out a video on that here on our YouTube channel as well. So looking at the structure, we are essentially repeating the exact same pattern that we had coming out of the February 24th low and into the late March area high. Now, obviously, in this case, we've seen a much more significant upside bid in the markets. If we take a look at the magnitude of that move, we were only 12.7% from the low in February, whereas moving from the June 17th low in the S&P before we rejected last week's resistance and proceeded to move lower, we were up almost 19%, 18.92% to be exact. And obviously that was even more impressive when looking at the NASDAQ and some of the semi names. So now that we have evidence and a completion of a third major price swing, that gives us two possibilities when looking at the S&P through the lens of the Elliott wave theory. And the first possibility we have labeled here, which would suggest that this is a new motive trend, up in a wave 3 position and down in wave 4. The alternate, as you can see, which is indicated by the alternate labels, would suggest that that's wave A, this is wave B, and we rallied up in wave C, meaning there's still the possibility that this is, in fact, proven to be a corrective rally. But here's the beautiful part about how we see the indexes currently. At the webinar event where I was a guest speaker last week, I brought the viewers' attention to the fact that if we take a look at the S&P, the Russell 2000, and the NASDAQ 100, only 2 of those 3 indexes would even support the idea that we entered a larger bear market trend from the November and January index highs. In the case of the S&P 500, we technically can't arrive at a clean motive diagonal completion. Perhaps this proves to be one instance where it is, in hindsight, proven to be valid, but for the time being, it's very difficult to view this as anything other than a string of Elliott wave corrections, which would include 3 waves down, 3 waves back up, and of course 3 waves down to June 17th. So even if we do accelerate through support and we see the indexes break lower, specifically the S&P, in the event we go south of 39.45 and we do revisit downside support near 36.36, we would expect this to only present an entry opportunity on the long side, and we do think that this would be a fairly short-lived ordeal moving lower. But again, we're optimistic and we think this is going to hold support and continue higher. So let's do this as we've been doing every week. We'll take you down off of the daily time frame. And what we're looking at here is essentially a breakdown of that entire movement from the January high in the S&P, 3 down, 3 up, 3 waves down, with now 3 waves back up. This is where the market can either confirm the uptrend, as we just mentioned. And so far, the pullback into the wave 4 position has been fairly steep. This has been a fairly aggressive pullback here in wave 4, and we've nearly met the major downside support zone near 40, let's call it 4050 to 4100. In terms of what this wave 4 pattern might be, the guideline of alternation would suggest that given the mostly sideways nature of the wave 2 here, that perhaps it does prove to be a more directional zigzag, where we have 5 down in A, 3 back in B, and another 5 waves down in C. But given the fact that we don't yet have a completed initial structure off of the high from last week, we can't say with a high degree of certainty if this is a flat or if this is a triangle. Could also prove to be a zigzag, which, as mentioned, would be supported based on alternation. But zooming in on this trend, when we met 2 weeks ago, we had identified what appeared to be a wave 5 ending diagonal in the making. And the ending diagonal actually had very clean completion. Was able to call the completion of this live with our clients on the 16th, taking a short position in the index. So now we wait. We look for structure. We look for a test of support. And once we have evidence of a completed 4th wave pattern, that's when we should see and be able to forecast the wave 5 rally. Now again, in a wave 4 position, this can be a flat, this can be a triangle. Technically, it could be a zigzag based on alternation. And if we take a look at the structure off of the high, the secondary move, and what we're going to do now is move lower in the time frame scale. I will keep this brief. Down here on the 15-minute time frame, If we take a look at the magnitude of the secondary move, so the secondary move came following this 3-wave retracement. We have 5 down, 3 up, and then another big 5-wave move to the downside. Generally, if this was going to be a 3-wave trend, we would expect C to be more or less equal to A, or perhaps 161% compared to wave A. In this case, we've seen a near 200%, if not 261%. We're nearly to the 2618 yesterday. So that would support the idea that this is down in 1, up in 2, down in 3, up in 4, and then we make a wave 5 move to the downside. We're going to be tracking that with our clients in real time. In the event we get 5 down and then we see a halfway back to 61% retracement in the B wave, there would be an opportunity to trade into C of wave 4. I wouldn't necessarily, depending on volatility, consider buying a put spread for C of wave 4, but it could be worth considering selling upside shorter dated call spreads into B wave resistance. That is, of course, depending on how this overall 4th wave trades out. And again, if we're to accelerate through support, you know what the alternate would suggest, and we discussed the invalidation levels yesterday in yesterday's public update. Over to the NASDAQ. Looking at the NASDAQ, we're up against the exact same situation here. We have evidence of 3 waves off of the low. This is where it can be proven a motive trend or trend establishing trend and set us up for a higher degree motive wave. We're looking at the same situation here. We are already deep into support in the NASDAQ. We'll be watching to see how this pattern responds. Support 12,818 up to 12,964. And then over to the Russell 2000 small caps. Taking a look at the Russell 2000, this particular wave count, in my opinion, really favors the idea that markets have just been in a big correction. Can we technically arrive at a motive trend off of the high from November, which would suggest perhaps we have another leg down that is more or less equal to this decline? While it's technically possible, I feel it counts better as a corrective wave. And looking at it as a corrective wave, we essentially have 3 down, then we do a big flat here in X, and then we have another 3-wave move down. In this decline, it's quite remarkable that the Y wave was more or less equal in magnitude and duration, and that measurement was met at pretty much the exact same daily candle. You'll also notice the corrective trend channel. So when we combine the support that we see at a quality of Y compared to W, the respect of the corrective trend channel, as we know corrections are often contained within parallel trend lines, and then we factor on top of that the magnitude of the move off of the low, it's truly best described as a motive trend instead of a corrective trend. And just take a look at the chart of Apple. Very difficult to be bearish markets with the magnitude of the rally that we've seen back in shares of Apple. So as requested, final chart, Russell 2000 small caps now watching 1890 up to 1908 area support. Looking for this to complete sometime early September, possibly out to the end of the first week of September. It could carry on further depending on what the pattern ultimately proves to be. We're going to be tracking it one wave at a time. I will, of course, do my best to update you all along the way. Although we didn't have our Wednesday live stream last week, if you are on our public mailing list, I did email you last Tuesday letting you know that I expected markets to begin their journey lower in the wave 4 position. So this is it, the most important 2 to 4 weeks in all of 22, and this should establish tone for the remainder of the year. So that's it from me. Let's jump back over to the trading analysis team. We'll get the screen share set up. What do you guys think? Lows are in? New lows to come?
Yeah, I think so. That's my vote. What do you guys think?
I vote lows in.
I think the jury's still out because I think both those wave counts that Bennett just presented are still valid. So, you know, from a technical standpoint, I don't see a difference. Now, I think sentiment out there is highly negative. Sentiment says that we're going to see and push to another low. It's either that or the bears are just trying to sell their ultimate case lower. So,
it seems like to me, this comes from pretty much all I've ever done in my career is trade. And as I started right out of college, I was a very short-term day trader, and then as I'm getting older, my positions are longer. But the one fact remains, regardless of the time frame you're on, you always have to take all the news that they're throwing at us in a summer market with a grain of salt. And this is the new age, digital information age, where there's the information flow is still very strong. But you got to remember, this is this is August, and this is the last week of August. Desks are understocked, volumes are down. We had some very low volume days. So just the pullback that we've seen, I feel like people have gotten very, very bearish. And as Bennett just showed, it's so far, you look at semis, I'll show you that. You look at Apple, the pullback is nothing. The Apple's off $7-8. It's up $50 from the low. And it seems to be that I think some of the more astute market watchers are now saying that the Fed is again behind the curve, focused on fighting the inflation fight, where they should now be concerned about driving us into a recession, where inflation, I view, is starting to, the view is starting to come off. So the Fed now needs to realize that they can't continue to be so tough, because inflation will come down and they can't drive us into a recession. And I think the Fed fund futures markets start to reflect that. And I think that's going to cause these corrected patterns that Bennett just looked at to be corrective and to move higher. So I think the Fed will come around eventually. That's my take.
Yeah, no, I'm in agreement. If we just take a look across, what's driven the move off of the lows, it's very difficult to be bearish from a technical perspective. And then you add on top of that some of the fundamental considerations. And I do think we have a strong case for basing support and continuing higher into year's end.
Yeah. Terry, do you want to go? Or I was just going to do some longer term wave stuff quick. Do you want to go first and I'll follow you up? Your call, man.
That's fine. We're already set up that way. I'll take the ball.
All right. Sounds good. Let's hit it. Sector focus. And then we'll be back taking a look at some historical wave counts. Take it away, Terry. See you in just a few minutes.
Hello, traders and investors. I'm Terry Long at tradinganalysis.com here with your weekly sector focus. So last week saw the S&P take a pause from what was a month-long uptrend that was reached all the way back up here to the 200-day simple moving average. Now it's getting that first rejection from that level. So typically we see a couple of tests of that level before we get a break. So not unexpected that we got a rejection right here. The NASDAQ index also broke back above its May highs, though it did not quite reach its 200-day simple moving average before it also has begun a retracement of this summer's rally. Now, last week, S&P closed down 1.21%. The index fell 2.38%. Price gains were seen, though, in the staples, utilities, and energy sectors last week, while all other sectors were in the red. The communications sector was the week's worst performer, down 3.14%. Materials sector was the second worst performer, down 2.4%. And technology and consumer discretionary were actually running around here in the middle of the pack, though they did underperform the benchmark S&P slightly. Let's go ahead and pull this out of the way, taking a look at this week. With a pullback now happening in the indexes, they are essentially back to the August entry levels, having erased the prior 2 weeks' gains. The SPX is down 2.04%. The index is down 2.42%. In the sectors, the energy sector is attempting to rally once again with the XLE up about 4.7%. Let's pull this over here and see where we're at this morning. Looks like pre-market action has pulled back the XLE a little bit from those higher numbers that I had, but 4.32%. The worst performing sector this week is the real estate sector, currently down 2.7% in 2 days action. And technology, here's the XLK down 0.81%. The consumer discretionary essentially flat. Here again, running in the middle of the pack. Now, over in our sector leader scoreboard, we've been following the path of the technology sector this summer. And as predicted, the technology sector has now moved back here into the leading quadrant. Let me animate this. The XLK, let's bring it back here. It began its hook. This is the week of June 17th. you can see that turn there in that vector, right? So that's where the transition occurred. And since then, we've seen the XLK progress up into the improving quadrant. It turned blue here. This blue improving weekly trend is based on the price structure of the XLK and its components on the week of July 22nd. And now by the week of August 19th, we see the XLK push over into the leading quadrant. Now, coming up right behind it, the consumer discretionary sector also continues advancing in the improving quadrant with gains in both relative strength and momentum that give it a trajectory forecast for it to likely follow the tech sector over into the leading quadrant in a few more weeks. Now, in terms of relative strength, the current sector leadership is utilities, healthcare, staples, and then technology, energy, industrials, all of these sectors outperforming the benchmark S&P. And note that the technology sector has been moving up the list. Technology is now fourth. It has overtaken the energy and the industrial sector in the relative strength ranking here. Now, it is also noteworthy down here that the energy sector, just prior to moving over into the lagging quadrant, has actually seen some momentum gains that have generated a reversal hook formation. So keep our eyes on that right there. The communications sector had been holding out in the improving quadrant, but with a lagging weekly trend vector, it just isn't able to make any advancements in relative strength. And now we actually see the XLC wanting to take another move back down into the lagging quadrant. We have seen a little bit of momentum in real estate and financials, but not significant enough to push those into leadership at this moment. Now, I got one more thing, and unless you have something else for me to look at, Bennett, I'll send it back to you. Let me just jump over here to energy real quick, because something that's very interesting. In our chart of the XLE, Bennett and I have adjusted this wave count somewhat last week on last Wednesday's webinar. A larger 3 waves down in A, 3 waves coming back in B. But there's this 2018 resistance level that held pretty sharply last time we approached it. We did get an overthrow and then the break back down below it. We think that this B wave may be completing, so this energy strength may be short-term lived, and I'll show you what's happening here inside the weekly RRG of the energy stocks. This is about the top 30 or so by market cap. You can see hooks forming in all of these, but look where they're forming. They're forming down here in the weakening quadrant and down in the lagging quadrant. These stocks look like they're staging for another push high. They got momentum coming back into it, but I'll tell you what, this could be a head fake move. So just leave it there with you, Bennett, and give it back to you.
Much appreciated. Thank you, Terry. Taking a look at energy there, it is very interesting to see how that 4th wave support zone did at least respond for 3 waves back to the upside. So let's continue to monitor that. All right, we're going to get the screen passed over. You're 1 step ahead of me. Awesome. You get there faster. You're already on the go-to-meeting window.
Let's see, Alex, do you want to go? And I was going to kind of comment on something that Bennett said earlier on Apple. I had some interesting stuff, I think, on what Terry said. Why don't we just, I'll go to the end. I was going to just do a super long-term wave count on the Dow and then kind of comment on what you guys did. So let me just step back and go last, if that's okay.
All right,
and kind of hear what Alex said.
Yep, not a problem, Todd. Sounds good. Alex, we've got the screen passed your direction. You ready to rock, sir? Take us through the macro scene. We can't hear you. You have muted yourself, I believe.
Sorry, guys.
No worries.
Yeah, I'm ready to go. I think screen is already shared, so let's go.
Yep, I've got you. It looks
Hey,
good.
man, welcome back from vacation. We missed you.
That's right.
Finally vacation.
Dude, you got it. First time in 5 years or 7 years or whatever since we've been working together. I've known you
already gray hairs.
Oh, you kidding me? They're coming in. Man, we tried to get you to take a vacation for a long time, and finally Alex decided to take our advice.
I'm a new
we missed
man,
you, dude.
I promise.
We missed you.
You need time off. You need time off. All right, let's hit it. We'll be back on the other side. Catch you in just a few minutes. Take it away, Alex.
Hey guys, let's go quickly over the macro themes. I have listened what the Todd and Bennett has been talking in regards of the count developments on the S&P and looking over these macro setups. I will definitely agree with them that inflation and inflation scare will have a pause, and I will try to make that theme, and actually that was a theme that I was pushing for a couple of months ago, looking at this chart. So let's look a couple of things. We have also a very important data coming in the next couple of weeks. So Fed meeting is on 21st of September. Week before, we're going to have the new CPI print, and next week we're going to have a new NFP numbers. So lots of data before the latest Fed. Also, we have this week the central bankers are gathering into Jackson Island or Jacksonville. I don't recall the real name. Jackson Hole, yeah. So it will be interesting to see their take. But looking at this chart, this is the 10-year yield. I think Bennett is also following this wave count. And we do see a potential fifth wave move on the upside. This has been just a small 3 waves down. So this is either a small triangle or something, even if we get some directional move, I don't think it's going to be a big one. And I do think that the rates are going to start to move increasingly lower. And we will see what the Fed, especially after the last CPI prints, which will be a week before, how they will process that information. So I do see technically this starts to show off into the data. The latest CPI was at 8.5. I think we're going to see a lower print, and that will actually start to force rates to go down in this corrective pullback. So I see that in many other charts, which I will show you. This is the European one. This is the 10-year Bund. Actually, the European rates are lagging, as you can see, because of the situation. ECB has pushed rates 50 basis points on the upside. They will have their meeting in the second week of September, I think on the 9th of September. So I do see this as a developing 5-wave move, but with a lag. They don't have such a bigger space on the upside to keep and move the rates on the upside because of the situation in the Europe. You know what the Europe is facing with this ongoing Russia-Ukraine war. But this chart looks relatively impulsive on the upside, so I see that continuing a little bit with a lag behind the Fed, but the same outcome. If we trace the 5-wave move, we're going to see rates correct on the downside. So if we look also the dollar index, I think we are in the last stages of this move on the upside, either this being some type of a flat down in a fourth wave or more directional move on the upside. I think we are very close to that reversal and a big pullback in a dollar, which actually signals that the Fed might pause with the rates, especially on the November's meeting. So if we look also the CME tool, we will see that the market is juggling with a 50 basis points and 75 basis points move. But if we switch on the 2nd of November, market is starting to price in already Fed being neutral. So this, of course, will change, and that will depend how the outcome actually it will be. But if you see, we didn't have so far, market started to price in the Fed actually being on pause, and now we have that already on November. So we will see the composition of that as the time goes by. But looking all of these charts, the probability, I think it's increasing that we will see actually Fed pausing in the next couple of months. going into 2023 and even more beyond that. So if we look some commodity charts, this is the Thomson Reuters commodity index. We have been tracking this for a couple of months now. You all see very clearly a five-way move on the upside, reaching some of the upside targets that we have projected for the wave 5. So we do think that here we're going to see correction in commodities. Many of them has fallen from its highs, and I think this will continue. There is clearly a five-way move from the highs, and I do expect this to continue further lower in this corrective move, which actually agrees with all of this number incorporated in the next data set that the inflation will go lower. I don't know exactly. I still don't have a number, but I think we will go down back around 6%, at least in the first move, lower in the next couple of months. So let's look a couple of other charts. This is the oil chart. We are bouncing off this support level. I don't think, as Bennett and Terry, that this move is done. Actually, I did last time something which I'm going to explain in the next couple of YouTube sessions. So I do see potentially that this is a wave 2 here, and we're going to go lower, and we're going to see, unfortunately, most likely higher prices, because if you look the rates, and after correction, what actually a little bit scares me, we have a five-way move from lows, which means that we're going to have at least another push on the upside when this correction is done. But let's go one wave at a time. We're going to address that when actually this correction is over. So as I see over the number of spectral commodity charts, and also when we gather all of this data that I explained, I do agree with Todd and Bennett that we are going to potentially continue higher in stocks. I think that the Fed will pause, and that the data incoming will be inflation lower. So all of these charts points into that direction. So let's just quickly look at gold and silver, and then we will pass the screen to Todd. So silver chart has corrected on the downside. We actually need to see a follow-up on the upside. We do have a nice 5 waves up from the lows, but of course, to overall confirmation of the higher degree trend, we need clearly 5 waves up in this blue wave 1. So for now, we are watching what is going on. I don't think that still is a time to be involved. I will wait for clearly a higher time frame confirmation for this outlook to actually unfold. I will also show you the gold and silver ratio, which I have been tracking for a long time as well. So on the gold chart, if we look at the current developments, you will see that 5 waves move from lows is also done. We need a confirmation as well. But we reached some of the targets that we have been looking for, especially if we consider this to be a flat. And this is the type of a flat which we call a regular flat, which means that all of these highs and lows are of equal measurement. So if you measure all of them, they're comprised of measured moves in relation to each other. And also, we reached 38.2%. Retracement levels, which we consider coupled with other Fib ratios as a kind of a handy Fib floor. Also, there is a 200 moving average somewhere around there. So we have this wave 4, I think, pretty much anchored, and we are expecting some nice development on the upside in gold. So that's from me, Bennett. So back to you.
Very good. Much appreciated there, Alex. Yeah, love the way the dollar index, I don't love the way, but I love the fact that the technical support zone did deliver as we were expecting. Interesting view in gold and silver. I continue to track the same wave counts, looking for evidence that that is, in fact, 3 waves back. If you guys are interested in crypto-specific coverage, please join Alex tomorrow morning, 9 a.m., right here on the Trading Analysis YouTube channel for Crypto Lab. You will be streaming tomorrow morning, correct, sir?
Yeah, as usual.
Awesome.
Hey, Alex, talk to us about euro at parity. I think that's the most important driving story. Like, how's the ECB handling this? How, what do you think the lower boundary is? I mean, I understand you have wave 5 move up, but what happens if it continues? Is there a point where they take even more severe actions to counter that euro?
Well, I think that ECB is just handling the narrative. I don't think they will go in any action. My targets are pretty close as Bennett's on the dollar index. So I think if you paid attention on these two charts between Fed and ECB, Fed is actually doing rates on the upside with a lag, which is usual, as you know, on the time on the FX. Which is usual, a couple of months difference between the Fed raising rates and ECB following. So I think that Fed will pause, ECB will continue with the small increments to follow on the upside, and I see a potential reversal in a dollar index and euro. I don't think there will. There has been some talks about their intervening, but I think that just a talk. For now, I don't see any action from ECB. To do any real, let's say, FX intervention on the markets in regards to that.
Got it. Yeah, and you and I both know that FX intervention, whether it's from the Bank of Japan, SMB, the Swiss National Bank, I think RBNZ, the Royal Bank of New Zealand tried it. It usually doesn't work. It just costs a lot of money.
I mean, look what's going on dollar yen. I mean, the Central Bank of Japan is holding 0.25 yield curve rates. So we have a classic carry trades from Japan going to US.
Which is generally a risk-on thing. And I kind of brought that up over the last 3 months. I said generally when dollar yen's moving up, global investors are selling yen at cheap, taking that money, investing overseas at a higher interest rate. And a lot of people push back, say, no, this is 2008 credit crisis again. Dollar strength as a result of flight to safety. I said, I'm not so sure. Look at some of these corporate earnings in the U.S.
I agree completely with you. Just the timing was a little bit off to see that on the price action in the S&P because it was still in the downtrend. So I think this
What was in the downtrend? What was in the downtrend?
The S&P started correcting. And this flows actually was probably buying a pullback. So I think potentially we're going to see that reflect in this continuation on the upside. So I do see this continuing. So I do agree with you. I think this was flogging into bonds, but it's still not reflected into price and in the stock market. I do think so.
Yeah,
I agree with you.
That's good. That's good stuff, Alex. That's good insight, man. Good to have you back.
Yeah.
All right. Hey, flip it over to me, Bennett. I'm just going to go backwards. And you guys all brought up really good points. I was just going to touch on, I think, something each of you guys said. And then I'll show you guys the super long-term count. I presented on Ben Zinga interview last week, and it got a lot of play. So you might be interested in that.
Yeah, if you could just grab the screen, pass it your direction.
Yep. Which screen am I? Number 4, share. Okay. Is that working?
Yep. CME Group and Optima in the background.
Yeah. Yep.
All right. Take it away.
Thanks, man. It's interesting. The data yesterday was horrible. I don't know if you guys looked at it, but manufacturing PMI 51, expectations of 52, and then global composite PMI is 45 on 49. So we had some pretty terrible data yesterday. The market actually rallied. Then we had new home sales that missed, and then today we're looking at pending home sales as well. And then we got our durable goods orders. The core, which excludes transportation and airlines, was up, but the headline was down. So obviously you're focused on, reduced transportation and airlines. I got to dig into that report a little bit here. But the data was terrible. And what Alex brought up was interesting. If you look at where the Fed is, where we're expecting the Fed to be, right now we're at a 2.25 to 2.5 Fed funds rate. So we're at a 41% chance of increasing 50 basis points. And we're now to a 58% chance of back to 3/4. And that's actually increased. So right now we're at 58%. A day ago it was 53. A week ago it was 40%. So even with some weaker data, even with the stock market pulling back, they're looking at going at 3.25. But I don't think it matters all that much, because if you look out to November, it seems to be the natural rate. The terminal Fed funds rate is going to be around 3.5, 3.75. So you have 47% chance going 3.25, and then 38% chance of 3.5 at the November meeting. And then, focus on the 3.5, 3.75 out to December. This is where it starts to slope off. The markets are very aware that the Fed is going here, whether they go there in 50s or 75s, however they get there. I think it doesn't matter so much, but that's where I think we're headed. And Alex's dollar resistance was interesting, because it is hard historically for the stock market to continue to rally with the dollar being so strong, being that so many of our market caps, large mega caps, derive so much value overseas, and they have to do an FX trade to bring the dollar back, those earnings back in dollars, which hurts that. But it could be, as Alex and I were talking about, like 1998, 99, while the world was selling their local investments, selling the local currency to buy dollars, to buy US tech stocks. You know how that wound up in 2000, but this is not 2000. This is a much different market. So I'm bullish. Okay, backing into what Terry said, interesting on energy, and I was looking at a few things here. Let me start this with growth value. This is just a very simple growth value, RRG. The left is the monthly and the right is the weekly. And what's happened is, on the monthly growth, just over the last two, we did move into the lagging quadrant. So this is over here where growth is very much in play. And look at some of those dates. That's early 21. That's May of 21. Sorry, my eyes are not as good. This small screen. And that's the flip into 2022. 2022 has been a big move out of growth and conversely into value. And the fact that we just crossed the 100 line here on the ratio indicates on a month, value is overtaking growth on a month over month basis. But what's interesting is on the weekly, it's completely opposite. Okay, so these data points, these circles are updated every month, obviously. These guys are updated every week. So obviously this is going to be change more quickly than this. The growth is now trying to move into the leading, and value has been coming out. And this is what I find interesting. Value has been coming off here ever since pretty much in the summer, while growth has been rotating in. And I'm wondering, do we get that push into growth leading and that move of value into lagging? But if we go down to the daily, you'll see, and I know this is kind of hard to follow, the last week or two has been all about growth selling and value buying, right? So value is rotating in, growth selling is rotating out. So I think the answer, when we get the new weekly and the new monthly, I don't know if we're going to get growth moving into the leading and value moving into the lagging, because again, what's happened over the last week, it's been growth moving away out of favor, and that's going to impact the weekly. So I think, I do still think the weekly is key. I still think, what we've seen in terms of growth, in terms of good tech earnings, in terms of consumer discretionary moving into favor, I think, we might have a little bit of a rejection here from this cross into the leading, but I think it's going to be temporary. And again, what I said in the opening is, it's summer. Volumes are low. We know where the Fed's going. We're at the tail end of earnings season. There's not a whole bunch driving the markets right here, except for a little profit taking. So we might get a little push away and into growth. That being said, what Terry said on energy, and I'm watching it, here's energy on the weekly. We're starting to move into the lagging on XLE, but we're starting to get a little bit of a push up here on the weekly. And then if you look at the daily on XLE, it's been nothing but rocket on the way up. So though I want tech, consumer discretionary communications, specifically the growth stocks, to do well, and I think they continue to do well. Right now, we have a little bit of a threat of energy rotating back in those hooks that Terry was mentioning in the energy stocks is interesting. So I still have a pretty significantly overweight energy position. I cut my overweight position in half at our last rebalance in July. But I'm going to be watching these energy stocks and see if the idea that, you know, we're still in a growth rotation is still valid, and energy is obviously going to be a value-driven stock. Okay, going back to what Bennett was saying, you know, you look at Apple here on the daily. I mean, okay, this is the largest stock in the U.S., and this is what we're talking about. This is a big deal on the pullback. That's pretty cute. That's a very cute pullback from a $50 rally. So you look at Apple. You look at the relative strength of Apple versus this is the NASDAQ. So Apple is outperforming the NASDAQ. Apple's also significantly outperforming the S&P. So you got to be looking for pullbacks there in Apple. You look at the semis. I was wondering if Bennett was going to hit the semis. Semis have begun to underperform, but if you look at where the wave count is, okay, so this is the semis, and I have a lot of semi holdings in our growth portfolio. You know, you look at the move up, and this is the semis relative to, this is the S&P. We were outperforming, and then all of a sudden, being that semis let us off the lows, because you can see that strong move up in the outperformance of semis to the S&P. We then went into what I think is an ABC corrective flat. Whether we have one more push down or not is fine. We can certainly handle that. But will semis reemerge here and come out of this corrective flat and push on up? And if they do, look for an outperformance of semis. And again, that would question what happens with the energy trade. I mean, we could, you know, it's not binary. It's not like semis have to rally while energy lags. I mean, they potentially could go at the same time. And then you look at NVIDIA, it's the same wave count. You know, we have a pretty good 5-wave move up. The outperformance ends. We go into this extended ABC flat, which then you start to see the outperformance end and actually underperform. But it's just that semis are consistently ahead of the market, and we need to look at these supports in the semiconductors, specifically SMH and NVIDIA. Let me get down to 195, and you say, okay, a flat should be a 5-wave move. So perhaps we have one more push down in the flat or in this C wave to complete it. It'll take me a second, but you see what I'm doing there. So there's 1, 2, 3, 4, 5, one more push down, and then any evidence of semi outperformance is going to give more clarity into that growth value discussion I had before. Lastly, let me just show you this. This is kind of controversial, but you know, we have some very, very dear friends at LIQUIDITY International. You know, we've worked with them for a long period of time. I'm happy to call Bob Prechter a friend. He's from upstate New York, where I am. He called me on the phone 2 weeks ago. We had a good discussion, and you know, he's obviously calling for a significant drop, and I have total respect for everything he's done. But I think, you know, I have a different interpretation as to where we are in the wave count. This is the Dow longer term. And what I find interesting, and this is back in the 1930s, this ABC drop, this is not showing the 1929 crash. This is the first counter reaction in 1932 post-29 crash. It's a 52% decline. This is the largest percent decline the Dow has seen based on Elliott wave corrections in almost 100 years. This is the stagflationary 70s. This was only a 23% decline, beginning a correction to end a correction. The correction ended here. Okay, and if you look at the 2000 to 2009 low, the correction started here. This is a B wave and housing credit crisis. The net decline was 44%. So what that means is the 1932 decline, even though it was shorter in time than both 70s and housing and tech, this was the largest percent decline. And in my opinion, price overweighs or outweighs time in terms of corrections. So I think this is one, 60s and 70s too, you know, and how do you not call the 1999 90s tech rally as wave 3, ABC and 4? And then, okay, so if we have wave 5, what does that mean? Well, if you look at the percent advance, okay, the percent advances were thousands of percentages. Okay, back here 32 up into the 60s and then 2000. You know, if you look at some of the stats I have up here as to where a reasonable upside projection in the Dow would be based on the distances of prior trends, you know, we look at wave blue 5. Okay, so this blue 5 right here is where we're talking about. 61% of distance traveled in one. Wave 1, again, wave 1 was post 1932 up into the 60s, was a 600% rally. Okay, 600% rally in wave 1. If you take 61% of that, okay, 61%, that puts you at Dow 39,137 as we trade 32,000. 61% of wave 1. Let me stretch this out. If wave blue 5 projected 61% of distance traveled in wave 3 was an 881% rally. If you take 61% golden ratio, that target is Dow 56,900. If you take wave 5 blue distance, 100% of wave 1, okay? Wave 1, 100% of that target is Dow 63,396. Okay, so based on all of these fib studies as to where this blue 5 could end, it's anywhere from 39,000 to Dow 63,000. And here's the kicker. And here's what keeps me up at night, literally. And I know we got to go. This is way over. Running a wealth management business, getting inside of people's portfolios and seeing what they're doing and listening to all of the outlets like ours, the information trading advisory businesses scare the hell out of people and get them out of positions, like, and costing them life-changing money by not being invested in the market. And listen, I launched trading analysis 10 years ago to take advantages of the ups and downs and ups and downs and ups and downs. You got to compartmentalize the time frames, but you got to keep your longer term money positioned properly. And Bennett and team add value for the short term, for the medium term, and that's 1, 3, 5, 6 months out. But you're talking decade on decade of investments. It's important to distinguish between that. Here's the final thing. Once wave 5 ends, I think it's somewhere within one of these targets, we're going into blue 4. What is blue 4? How do you get the guidelines for how long blue 4 should be and how long it should last? Well, you have to go to same degree wave 2. And that's back here, post 1932 or post 29, 1932. So it's a 52% decline. And if this is an ABC zigzag, which I very much believe it to be, the guideline of alternation, as Bennett said earlier, would say something sideways and something less percent change than what we saw in 1932 if it's the same degree. Okay, so it might be a sideways chop fest, and maybe people are early on the premature stagflationary 70s. Maybe we have another pretty significant rally up before we go into sideways movement, where then you're very much needed to be active with your investments longer term. So I just want to throw that in front of you guys. It's amazing how many people are scaring people, just out of the positions and saying I missed everything and I never got back in post-COVID. Well, it could only get worse. And then once everybody gets in post-COVID is when we go into a sideways chop fest where you're going to need to be very tactful. So just want to throw that out there. Hope that helps, guys. Bennett, team, back over to you.
Very good. Much appreciated, Todd. Excellent longer-term view there in the Dow Jones. I always love working monthly and 3-month charts, looking at the overall historical wave count, the higher degree of trend, which I continue to view as still well intact as you do. So good stuff. Markets are open. We've been open here about 27 minutes or 17 minutes. Take that back. Indexes moved slightly lower, but I do think that the indexes are gearing up to round out that either wave 3 or wave C position. S&P has a fib near 4107 to 4100, so if we do accelerate lower on the session, keep your eyes on that support zone.
Hey, I'm not dead. My screen is frozen.
Oh, is it really? Your camera froze? I'm sorry, Terry.
I didn't fall asleep on y'all. So.
I've been there, man. I've been there.
We got to get some color grading in there, man. It looks like you're looking
I
like an
got to
episode
work
of Ozark.
on that again. That chroma key thing.
I'm keying out half of his shirt, Todd. That's the problem.
Hey, let me throw something real quick, just one more minute in on that growth. On that growth, okay. So
yeah,
the three sectors that typically form growth is technology, consumer discretionary, and communications. Communications, of course, was a break-off that happened a couple of years ago. Part of healthcare is also considered technology. So just not the whole sector, but part of it. So anyway, what I shared with you is I showed you that we have one of those three sectors, those growth sectors, has just now entered the leading quadrant. Consumer discretionary is still a few weeks behind, and indeed it's possible that consumer discretionary rolls south before it gets to the leading quadrant. So all of Todd's points are totally valid. So if you look on the weekly, look over there on the weekly, yeah, there's the consumer discretionary. Yep. Probably within 2 more weeks, if we don't have too much velocity degradation, 2 to 3 more weeks on that trajectory will put consumer discretionary joining technology, and then you've got 2 out of the 3 there. Now the communications sector, it's a smaller overall market cap, but it does have Google in it, right? So Google and Netflix are pretty huge, but communications is still lagging. So yeah, we're not going to go full on bore growth, but I do think semiconductors are included, one of the biggest things that pushes the tech sector, but it's not everything. So yeah, you got 1 out of the 3, and there we go.
And that's an XLY over on the daily, to your point. I mean, it was diving away here in the last 5, 6, 7 trading sessions, but as those dots get closer together, that, Terry, help me, is that momentum, or what am I studying by distance between the dots?
Velocity.
What is that called? Velocity.
That's the velocity.
Velocity is, it's rate of change, like that RSI indicator you guys watch, or rate of change. That rate of change is lessening.
Yeah, it's no longer seeing momentum decay because it's gone horizontal there. So and even a slight uptick in momentum is a good sign, but it's still holding high on the daily. It's consumer discretionary is still holding high relative strength. So
and this is something you and I should explore. Like, I would expect to see more of a negative relationship between XLY and XLE. The higher energy goes, you'd expect to see the consumer squeeze, but it seems to be, as energy is roaring back here in the daily, consumer discretionary is like, yeah, okay, we'll hang for a minute, we'll admit it, but then they're like, yeah, screw you. And I don't
think the time frame is or the time frames for that effect that you're thinking of is perfectly aligned. So,
meaning what?
Meaning on a daily basis, any move in energy is not going to immediately cause a negative move in consumer discretionary.
I would counter that and say that billions of dollars running in algorithms that are tracking this make it so. I would definitely push back on that. But I would say that is actually an interesting, the fact that consumer discretionary is not reacting. And here we go. I mean, we have NVIDIA down 1% here. I'm wondering if the semis are trying to make this final C of a flat to give us that wave 2 correction, and then maybe they reemerge. And then the other thing, I was on CBC yesterday, I think, or 2 days. What day is it? I was on Monday, and we had a long discussion about Amazon. Amazon's come back, man. They've had a huge problem in the first half of Q2 earnings. They've been a pretty significant underperformer, but Amazon is showing signs of coming back. I have about a 3% holding in Amazon in our growth portfolio, and if we can hold the 120, 125 area, and this is right in line with this consumer discretionary discussion, I would actually consider adding to Amazon for the first time in a long time. They're starting to straighten up their financials. They had a Rivian investment where they were taking it in the shorts on that one, and that's sort of coming off, but it's symbolic of that consumer discretionary story. And again, with 75 basis points back on the table, we know we're going to 3.25. Energy might be strong. I say good for XLY relative strength. We'll see what happens, though.
Very good. Good stuff. Appreciate you all tuning in. If you guys are interested in more content, you can visit us anytime at tradinganalysis.com. Please subscribe, turn on notifications, let the YouTube algorithm know to distribute it accordingly. And of course, members, we'll see you in about 7 minutes for our weekly member webinar. Todd, Terry, Alex, good work. see what the markets bring, watch the wave 4 support zone, and we'll go from there.
Good show, guys. Thanks for having me.
All right, sounds good. Have a good one, viewers. We'll see you next week. Take care.